Now, Asian currencies had a difficult first half of 2026. The region had to deal with higher oil prices, hawkish Fed repricing, firmer US Treasury use, intermittent dollar strength, and geopolitical uncertainty. But performance was not uniform. Differentiation was the key theme. Higher beta and net oil importer effects such as Korean won, the IDR, the Indian rupee, the Thai baht, and the peso came under more pressure. Lower beta or policy-supported currencies such as the Singapore dollar and the renminbi held up much better. Looking into the second half, the backdrop has improved, but only partially. Oil prices have eased back below $80 per barrel, and that provides some relief for the region, especially for the net oil importer countries. Now, it helps to ease pressure on external balances, inflation expectations, and fuel subsidy concerns. But we will not read this as a clean risk-on signal. Geopolitical developments remain fluid, and any renewed escalation could quickly reverse the oil relief. At the same time, the Fed remains a key constraint. Recent Fed rhetoric has been hawkish, and markets have repriced towards an elevated rate policy setting. Now, that keeps the US yields elevated and limits the room for a broad-based Asian currency recovery. Our base case is therefore not one of uniform bearishness, but also not one where the Asian currencies is fully out of the woods. We think Dollar Asia could still edge higher in the third quarter as the region digests hawkish Fed rhetoric and fragile risk sentiment. But into the 4Q and into 2027, we look for a mild downward trajectory in Dollar Asia, assuming oil prices remain contained and the Fed does not follow through with aggressive tightening and global risk sentiment stabilizes. Now, within the region, we still prefer to stay selective. The Singapore dollar and the renminbi should remain relatively better anchored, although for different reasons. Now, the Singapore dollar retains support from its lower beta characteristics and the effects of MAS's tighter policy stance. The renminbi remains guided by the PBOC's fixing bias, although softer China fundamentals could eventually test the durability of renminbi's outperformance. Now, we adopt a neutral to slight cautious stance on the Malaysian ringgit as the earlier fundamental re-rating appears largely in the price. The Indonesia rupiah has room for a potential tactical rebound, helped by BI's policy response and softer oil prices, but the recovery remains vulnerable to renewed oil strength and higher treasury use. On the cautious side of things, the Thai baht may remain on the back foot given Thailand's softer growth backdrop and limited policy support for the currency. Now, the Korean won is also not a clean AI beneficiary, as export strength has not translated clearly into currency strength due to resident offshore investments and foreign outflows. So overall, oil relief helps, but it is not enough on its own. The key risks remain the Fed, the dollar, the US Treasury yields, and geopolitics. Now, in this environment, Asian currencies should remain differentiated, and currency selection matters more than taking a broad regional view.